to start out with a topic which is hopefully relevant for everyone. I'm going to tune into topics around data and AI, which I'm sure all of you are very interested to get into from an audience perspective. But maybe I'll kick us off, Kathy, with talking about the market context. We've had an extraordinarily unprecedented last couple of years in real estate. Starting off with COVID a couple of years ago, we then had the regional banking crisis with a specific focus in commercial real estate where the lending environment was incredibly challenged. And now we've got incredible geopolitical uncertainty. I would love to get your take, given your vantage point, on where are we in the cycle, what opportunities are we seeing, and where do you see us going from here?
Sure, and just to give some context, I've been in this business for a very long time, since 1987, and so that puts me as someone who has seen many cycles, including sort of beginning with the savings and loan crisis, all the way through to where we are today. And I can say for sure this is the strangest period of time that I've ever experienced. It's very, very difficult to learn anything from past cycles in terms of trying to figure out where we are in the market now. And I'll give a perfect example. Once we got through the global financial crisis, think mid-2010, we had a major correction in real estate values. Now, of course, interest rates were quite low, but the behavior back then was that as soon as people were comfortable that the market had bottomed, participants just were flooding back into the market. And it was an incredible opportunity. It was probably a generational time to buy in the market, and people acted like that. People did what you would expect. And now if you compare it to where we are today, if you think broadly geographically around the world, most prices pretty much stabilized mid-2024. So we're a year plus from that time, and I would hardly say that capital is flooded into the market. Transactions activity is definitely increasing. Things are looking better. But if you look at some of the indexes, and I'm going to reference the core open-end index in the US, the Odyssey index, we're coming into the sixth quarter of positive total returns, positive appreciation for about 4 quarters, and even if I'm correct, 2 to 3 quarters of positive appreciation in the office space. And yet, many, many institutional investors are still on the sidelines. So you might say, well, maybe that's because there's not enough credit in the system. There's plenty of credit in the system. That's like the least of anybody's problems. So you have a liquid market from a credit perspective. You have a complete repricing of the market pretty much across the globe and across sectors. And yet, you still don't have that investor behavior that every other cycle I would have seen would have told me was going to happen. So it has been a very strange period. What I will say right now is that I do believe that we're coming out of this. We have seen within our shop, transactions activity is pretty much double what it was last year at this time. I haven't seen the same metrics with respect to capital inflows from institutional investors, although it's definitely getting a lot better. I will say in terms of how I would give myself a grade, last year I might have said the same thing around the same time and I would have been completely wrong. So I ended 2024, most of my colleagues did as well, feeling very, very optimistic about 2025, and then we had kind of an okay beginning of the first quarter of 2025, and then the tariff situation kind of put the freeze back on, and in a way it feels like people are hypersensitive to any indication that maybe there should be a freeze put back on again. It's sort of like the slightest little thing and everybody kind of stops in their tracks from a momentum perspective. So I'm actually feeling very optimistic again about 2026 and hoping I'm right this time.
We've had a few years of every year we feel the next year will be better.
Yes.
So that'll be a pattern we probably see continuing for a bit. Luke, you've been in kind of the crosshairs of the sector that has been at the forefront of geopolitical uncertainty with industrials and logistics. What are you seeing in terms of the market?
Yeah, I think Kathy touched on a lot of things. I think what I see for the capital formation, uncertainty is not great for business. In any business, I think, even up to last weekend, we saw just a significant shift in tariffs again, but uncertainty is not great. But, on the converse side, the resilience of the US economy is real. What we've been seeing, we've leased more space year to date than we did a year ago, and that's with global wars, that's with tariffs, an incredible amount of uncertainty. At Link, we own about 500 million feet, so about 5% of the US economy flows through our 8,000 customers, so I think we have a pretty good cross-section. But I think what's helped our sector, and I think a lot of real estate sectors, was the start of this sort of cycle was the raising of rates. So development started to precipitously fall 2 years ago. So we're sitting right now in a sector where we continue to see e-commerce growth. We continue to see the reindustrialization of America, whether that's data center development and supply chain, or just the $500 billion of announcements that have been made in the last 3 years, and then compile that with collapsing new supply. The actual sector, in what everything Kathy just said is so right, but the resilience of the consumer and just the US economy at large, I think, has been shining through this year, and our numbers continue to support that.
That's terrific. Toby, are you seeing similar tailwinds on the residential side?
Yes, I think, so I'm in the multifamily business, and my company manages about 130,000 apartments, some of which for Kathy and others. And that side of the business has been quite favorable. There's been a lot of supply from the COVID era, but depending on the city, it's beginning to burn off demonstrably. There's still some hangover in Miami, Atlanta, Nashville, places like that where there had been a large amount of supply. But generally, it's getting absorbed. So what had been a very good resident market is turning quickly into a positive landlord market. It's an interesting time. Coming behind all the development from COVID is almost nothing. The feasibility, and you all touched on it a little bit, the feasibility of the creation of new housing, the returns are so anemic that it does not justify taking the risk at this time to do so. If I was to start a new project tomorrow morning on the development side, it would still take 2 years. So everything inside of me and intellectually says this is a great time to start, because you'll be delivering into a completely supply-constrained world with a ton of demand. But at this moment in time, it's very hard to attract equity. Debt is prevalent at the moment. Equity is a bit sidelined. So a company like mine used this moment to put together a fund to acquire buildings. And the thesis there being that we can buy full Class A buildings at a 10 or 20% discount. So as Luke said, there's a tremendous amount of uncertainty in the world, and uncertainty makes transacting business very difficult, as you all know. The positive side of that is not everyone's doing it. And these downtimes are where you find immense opportunities. You just have to have some fortitude to proceed with it.
You made a great point there around how you act in this current environment is critically important, and differentiation of players is becoming even more important. We're seeing a greater divergence in rents of Class A properties versus other properties across asset classes. Stephen, how are you leaning into differentiation in your space? You all have been big on customer insights and how you use customer insights and the flywheel around that. How are you leveraging what you know about your customers to really differentiate your product and your experiences?
Before I jump into that, I just want to echo what everybody else just said, because it's really interesting, the dynamics of the retail market. I represent the retail sector here today, and I'm thrilled to be part of this conversation. But similarly, there's not a lot of new retail development that's happening either. So if you take a look at this retail constrained environment with department store business contracting, Macy's closing a number of stores, a lot of department stores closing. You've got a lot of brands that are out there looking to add new stores into the marketplace. So for us, developing doesn't make sense either. Right now, it's an acquisitions business, and we acquired a shopping center in Kansas City 2 weeks ago for 40 cents on the replacement dollar of what we built something 4 years ago in Nashville. So it's a pretty amazing market. If you've got access to capital, then you can take advantage of the opportunity to go out and buy stuff. As far as customer insights, we're primarily in the outlet business. We're open air shopping centers. But in the outlet space, the uncertainty sort of creates a little bit of a market for us because a number of things are happening. There's a lot more product that's coming into some of these stores, and whether or not the full price stores are transacting at full price, a lot of that inventory makes their way into our channel. And it gives the retailer an opportunity to sell that off price while still maintaining their brand integrity. So they're not necessarily putting it in a TJ Maxx or a Loehmann's where they're hanging with a bunch of their competitors as a commodity. This is really brands selling directly to the consumer at value pricing. So we're seeing great opportunity for new businesses to get into our sector. So as an example, using some of that insight, some of the information that's out there, it's important to us to drive customers into our shopping centers, a dynamic that's unique to outlets, because most of our brands don't use their marketing capital to say, hey, come shop off price. They're saying, let's spend our marketing capital to send people to Madison Avenue. Because of that, we have to use our marketing machine to make sure not only are we marketing to the consumer to come into our centers using the best brand names that we can, but the consumer is saying to us, hey, here are brands that we want. We want Fiore, we want Athleta, we want Lululemon, we want more athletic fitness product in the stores. Bring that into your shopping centers. So, our team is leading with analytics in order to go after the best possible retailers to populate our shopping centers.
Andrew, Stephen said if you've got capital, you should go buy stuff. You guys have plenty of capital, Aries. What are you going and buying?
What are we buying? Oh, you're asking Dave.
Yeah.
We're active across sectors, and I think we're on track for this year to be up meaningfully from last year, and last year to be up meaningfully from 23 in terms of our U.S. deployment, and we'll probably surpass 22 and 21 levels this year. And it's really been some of the themes we've talked about of finding conviction in a dramatic decrease in new supply. Right, and when we look historically, we think real estate cycles tend to end either with excess supply or excess leverage, and a 500 basis point change in rates starting in 22 through 23 certainly put the kibosh on the supply side of things. I think we've seen fragmentation of demand, first in office coming out of the pandemic, and then certain companies delayed making decisions about their space needs because of uncertainty about either the rate environment or the tariff environment, but generally they can only put off those decisions for so long. And so similar to what Luke was saying, we've seen our industrial leasing go up fairly materially this year over last year. I think the broader market has as well. We're seeing more users commit to buying space that we've developed. We are starting to build apartments again, and you do have to have a little bit of a belief about the fundamentals tightening, and I think one of the things that we enjoy about the ability to invest across asset classes is you can see activity pick up in one space and then start to infer forward what you're going to see in other asset classes. So for us, the busiest areas continue to be logistics and for-rent housing strategies, but we've probably been more busy in retail over the last 12 or 18 months than we have been in the 10 years prior because of some of what Steve was speaking about.
It's fantastic. We've seen a barbell of performance with players who have scale and financial muscle performing well, but also very nimble operators who have really good market insight, players who are vertically integrated. Toby, you run a fully vertically integrated business from all the way from development through to operations and all of the customer interactions. How are you leveraging your vertical integration across the business to really drive alpha and outperformance?
I think for those of you that don't know, I have a development, construction, and aforementioned management business. And our common theme at our company, I tell people we're in the business of creating apartments or providing service. but that's really a conduit by which we're creating experience, or what we call sanctuary for our residents. So it's this perhaps old school idea of high touch customer service. And it's a very interesting time because high tech, as evidenced by this entire conference, in some ways could subsume human interaction. And so we are trying to find a way to marry high tech and high touch. Having a vertically integrated business allows us to look at projects or experiences in hopefully a more holistic manner, in a more honest manner. We're not farming out any of our services, so we really hope and believe what we're doing is the right thing. I will tell you also that having a vertically integrated business is a fantastic idea generally, as evidenced by recessions or whatever we're in now, a dislocation. If I was just a developer or just some other thing, it would be extremely, extremely difficult now. As our development business has waned, we've pushed some of the developers into an acquisition role and so forth. We've put other people in different parts of the company. So I think perhaps it's like a tree with a very wide root system versus a singular trunk. So that has allowed us to take these, what I'll call, hopefully aberrational moments. You know, we're in a cyclical business, and when it's cyclical, we're all completely shocked. So we have to remind ourselves that this is normal. So how do we prepare our respective businesses for that inevitable turbulence and find opportunity, to my previous point?
Luke, how do you do high tech and high touch in industrials when you're touching customers with warehouses?
Yeah, so it's interesting. Industrial, I think, up to probably, a decade ago, was very uber fragmented. Fragmented ownership, fragmented users. I mean, Link's a good example. We have 8,000 businesses operating in our warehouses, but there's been a number of people. You talked about scale. I think of size and scale as uniquely different. Size can be acquired. If you had $70 or $80 billion, you can buy 500 million feet of industrial. You can do that. Scale is connecting the dots between all these interactions, whether it's technology, engaging with them. We've built our own portal for customers. The data that we're now able to collect. I look at two businesses that I think have led industrial. Steve's business on the customer side, I think customer experience, not only is it the customer, Steve just talked about the customer's customer. Allo's your customer, but it's their customers that matter, so that's retail. And then in apartments, the data that they're able to use to price apartments and do that is so unique. Industrial really was a merchant asset class, and it's probably over the last 5 to 7 to 10 years, we have really at Link tried to build a scaled operator that provides customer, being our business operations, and provide them support and other ancillary services, but then also use that data to be able to find out where are the paths of travel, where should we be building buildings, does clear height matter? I think that is, if you can use scale like that, you can deploy capital with a finer pen and a sharper knife, I guess.
It's fantastic. Yeah. So let's switch gears, given the segue on data, to data and AI, which I'm sure is a hot topic for most in the audience. We've seen 70% of organizations are saying that they're experimenting with some form of generative AI or agentic AI, yet only 1% of organizations say that they've actually seen any bottom line impact from that investment in the short. Are we being too short-termist in terms of our view towards the impact of AI? Would love to hear examples from you all. Kathy, maybe we could start with you on how you're using data and AI across the organization. What do you all see as real examples of impact? Where are we going to see pockets of hype?
Yeah. I'm so happy to hear your statistics that only 1% are saying that they've already seen an impact, because I think sometimes if you listen to the hype in the industry, the number of people who tell me that they have, AI on the investment committee, which maybe they do, but, I do think that there's a difference between experimentation, dipping your toe in the pond, and actually, voting yes or no on a new deal because AI is telling you to do so. That there's a huge kind of, gap there. For us, we have been at this for many years. I wish I could say that we have, solved the whole problem. We have not. And that's why I think that gap exists that you mentioned, the 70% to the 1%, because it takes many years of trial and error. And that is sometimes difficult to accept. For me, it's very, very difficult to accept, but I'm getting my head around it that most of what we try has failed or is not perfect. And that's probably going to continue. And that just means to me that you just have to keep trying and trying and trying. So, where have I seen, there's various categories, right? There's kind of the property operations. And with some of our partners like Bozzuto, you have the ability to pilot different technologies and see how they work. And we've had some great success there, around the world and across the sectors. There's definitely some super interesting technologies that are, A, improving operations, B, improving sustainability and our ability to continue to up our game from a sustainability perspective. There are things that are really just around the tenant experience, which is, extremely important. We heard a few examples here, and my observation over the past, call it 5 to 10 years, has been that all real estate is converging upon hospitality. The hospitality industry was always and has always been about creating experiences, memories, making people happy. When I first started in this business, in office, your responsibility was shelter over someone's head, and in apartments, it was to provide a place to live. And now, even in an office environment, you're responsible for people's social lives,
Yeah,
their
it's like a
well-being.
hotel.
It's exactly like that. And some of these technologies are helping there. I mean, there's a technology that we have piloted that can sense whether someone is in an office building and maybe even having a heart attack, right? It's sort of a sensor type thing. So things about, air quality and all of the things that people expect now from a wellness perspective. So there's so many great things. So that's kind of the operations, property operations. Then there are the things that, we as investment managers can employ to try to make our business more efficient, more effective, to deliver to our clients, which are really our investors and our borrowers, to deliver to them in a better way. And then I think the thing that is probably going to be among the last things to be solved, in my view, is the how do we become better investors? How do we make better investment decisions? I always use the example that if 20 years ago we had a very strong evidence and view that Nashville was the Nashville of then was going to be the Nashville of now, we would have bought every acre of vacant land in Nashville. So how do you gain that level of conviction? So those are, I think, the categories, and I think it's just a journey.
Yeah, and what we've seen is sophistication on data usage for things like single-family homes is now porting to more commercial and institutional transactions, which is a fantastic evolution on investment sophistication. Luke, you've built a large internal capacity. How do you think about building internal capabilities for doing data and AI versus what you can use third-party solutions for?
Yeah, we think of, it's probably similar to Kathy. I think of AI simply in 3 buckets. There's probably more. It's like repetitive automation, so RPA. I think that's ubiquitous. We're testing with that, whether it's using Cursor for coding or Adobe or Workday to do lease abstraction. I think that's all going to come to us. We don't need to be the front runner of that. The second one is cognitive engagement, whether that's a chatbot with customers. But I think of it more internally. We're a huge absorber. Our team is a big data-hungry team, so lots of dashboards and data sets. We've got a Link GPT where you can just type a question in and it'll start just delivering you information. And culturally for us, it means every single person in our firm will just swim through our information. The one that I think we're spending the most time on, and it's the hardest, is what we call cognitive insights. And that's what Kathy, how do you get models to see around the corner? I think the first 2 are things that we should all share and learn from each other. The last one is super proprietary. If
Yeah.
you can work out how to see around the corner,
Yeah.
you try to get around the corner before everyone else. But that is very, very hard. We have data scientists working on it. But I think, the first thing, like if someone said to me, how do you get good at AI? I think it's testing. Kathy sort of touched on it. The other thing we did years ago is build a proprietary data set that is enormous. The bigger the data set, the more it can learn on, the more of an edge you have. So we've been very lucky to be able to do that. But even if you don't know what you're going to do with it, the more data you have, the better sort of performance.
And as you think about operating as part of a bigger platform like Blackstone,
Yeah.
are you able to leverage signals from the bigger platform?
Yeah,
Decision
absolutely.
making?
Yeah, I mean, we're one of Blackstone's largest portcos, and yes, we do. We work with their data science team. They have a whole AI team. I mean, Steve and John, Steve particularly, have been one of the forefront leaders in AI. So we've been able to work and see what they're doing across their businesses. But it's still like that 71 feels right. Like there are definitely efficiencies we're pulling out of accounting and out of legal and out of technology, but this isn't this watershed moment that you're like, oh my goodness, it's like a 40% margin increase. We haven't found that yet. If anyone has, I'd love the answer.
Yeah. Toby and Stephen, love to get your take on, banks have said they didn't need branches. Now they're saying they don't need humans for servicing because agents can perform all of the tasks in the call center. Why do we have so many humans still in the real estate ecosystem?
Do you want to
Where do we see this going on residential and retail?
I hope they continue saying that because that creates an extraordinary market position for many of you in this room. When you build a new building, I'll just walk you through this. If you're building a new building, the rents that you have to charge for a rental apartment are exceptionally high due to the cost. For that for the price, I want our customers to get a value. And value is so often conflated with being cheap, but value can be you've had a tremendous experience. Think of it if you went with your spouse or your partner to a beautiful restaurant, the ingredients were beautiful, the food was beautiful, and the ambiance. You're not unhappy that the bill was $200. We are offering that level of expenditure, probably your highest. So it is my belief that the human interaction is tantamount. If you can use AI or imbue your projects with all sorts of different technology to reduce the friction that your customer feels, as Kathy mentioned, it really does help them. But at the end of the day, creating joy, lighting people up, finding that human connection, pulling a humanity thread through this as a through line, I think is where you could do extremely well. And I think that will continue to be a standout in a world that is getting less and less customer interface.
The bar keeps going up for experiences. Many of the activities get performed in an automated way. Stephen, what do you see in retail? How do you see it evolving?
Well, interestingly, I grew up as a transactional real estate guy. I was leasing stores my entire career. And when the company that I worked for bought a building, the first thing you would do is you spend the first week, 2 weeks trying to figure out the hit list. Who am I going to go after to put in that shopping center? Because it's my job to re-merchandise and do the leasing. Interestingly enough, we bought a center in Kansas City a couple of weeks ago. And the day we bought the center, I went on AI, my little chat GPT, and I said, hey, make a list of retailers that are typically found in one of my centers that don't exist in Kansas today. And I got a list of 25 retailers. So instead of taking 2 weeks before I could make my first phone call and start canvassing and calling retailers, I have a list right in front of me because that work had been done for me. And I just think that, people talk about, is AI going to replace people's jobs? No, it's going to make my leasing team that much smarter, that much more efficient, and that much able to hit the ground running on day one, start to go out and make deals.
That's great. Andrew, how are you all leveraging data for investment decision making?
So it's always a privilege to be the last and hear everyone else speak and be able to echo some of the themes. And I think the themes are the value of the internal data, particularly when you have a large data set. And we started a little while ago talking about vertical integration and sort of the barbelling of the market, and being on one end of the barbell with some of our large alt manager peers. The quality of data and just the flow of information is something that we use to inform better decision making. I don't know that the AI models are there to see around the corner yet to spot the next market 20 years down the road, but leveraging that through different internal tools and proprietary tools, I think, is where we see the market continuing to evolve. Every large firm has access to the same third-party data and analytics, but it's the internal data that's really important. From an operational perspective, and our business has gotten more vertically integrated over the last 5 years, the customer relationship side is wildly important, particularly when you're talking about large, sort of unique, bespoke decisions. So if you're meeting with Amazon, understanding their strategy and how they make decisions, whether it's warehouse space or a data center, still the relationship and the human interaction matters tremendously. Earlier this year, we acquired a self-storage platform that is fully vertically integrated. We have 65,000 tenants. There we have a team of about 15 data scientists who are figuring out pricing for each individual unit each month. And that's something where the automation part, I think, matters much more because it's effectively more homogenized kind of product and less relationship driven. And so I think there are very specific use cases across the board that you need to invest in and think through both individually and distinct, and have a view as to how you want to move forward more holistically as well.
Maybe we said we want to give examples to use, just to dovetail on that one. We have 8,000 businesses, big and small. Like, think of the smallest business in the United States to the largest, Amazon. This is what we think AI can do. We can vertically integrate. We talk to our customers in their warehouse 4 or 5 times a year. We're going to be trialing with Salesforce that you go talk to the customer. Instead of filling in a survey, once you finish talking to the customer, you come out and just dictate to your phone, and it logs it in Salesforce. This doesn't seem super novel. But then what AI can then do, imagine doing 8,000 a quarter, 32,000 meetings a year. We're going to be able to say, did you know small business in Northeast Dallas mentioned positive incremental growth more than they did a year ago? Like, you start to get this real-time pulse of what's happening. In retail, you get to see retail sales. Everyone in industrial is like, how can I see the US economy at the tip of the spear? This wasn't a possible 3 or 4 years ago. It was like, you have to ask the survey. Now it's like it can actually extract insights out of just traditional language. And that is the competitive scale of it, advantage of scale and vertically integrated. If you don't have both of them, that doesn't exist.
Toby, you wanted to jump in as well. Go ahead.
There's a great book I read, I would recommend, called Co-Intelligence, and it's about AI. And his thesis is essentially that it will take someone trained in the humanities or in critical thinking. Everyone up here has given you amazing examples, but they're all brilliant, and they're all trained in critical thinking.
Right.
And they've learned how to use AI as an extension of their brain or their arm. And it's doing amazing things. And you all are the same way. So I think we need to view the fact that humanity itself, or the user of AI, those with tremendous intellectual curiosity are going to be, or creativity, are going to be able to amplify AI to create beautiful things, reduce expenses, make your customer's life better, and so forth. So
that is a fantastic insight, Toby. And just segueing off that point, in the last few minutes here, I'd love to talk about leadership and being a CEO in this environment. Some would argue that this is one of the most challenging environments to be a CEO, with the amount of change that we have going on externally and the pressure on internal talent coming from other sectors which have incredibly well-backed venture capital funded ecosystems, and the ability to compete for tech talent and AI talent in particular is incredibly hard. How are you approaching this environment. Andrew, I'm going to start with you so that you don't have the benefit of going last this time. How are you approaching the role of being a CEO of the business? What are you doing to upskill yourself and lead your team?
So I have the privilege of heading one part of a larger real estate business that's part of a larger firm. And so it may be a little bit different than some of my peers here. But I think it's sort of a good transition from where we just were, of how do you harness all of the information across the organization and push that out to people and encourage them to have resilience, a growth mindset, a desire to do better, to form teams quickly, disrupt, try things, occasionally fail. That's part of the cost of growing. And trying to create a framework where people have as much role clarity as you can give them at that period of time, and then ask them to go out and push. And I tend to be a big reader of things on servant leadership and teamwork, and I think Ares is a firm that really values collaboration. And so those are some of the things we try and inculcate in the teams, and then share best practices across to scale them up.
It's great. Why don't we go around?
Sure. I guess for us, so, if you look back, I started at Tanger in April of 2020, 15 million square feet, 40 shopping centers, 3,000 stores. They're all closed. So the role of the CEO was much different.
You could only do better. Yeah. You could only go up from
What a
there.
brutal
That's what
time
I
to
told my
join
wife.
retail.
She said,
Oh
"Are
my
you
goodness.
crazy?" So,
Set low expectations.
so the role of the CEO at that time was get behind the company and push the thing uphill.
Right.
Now that we sort of, we've gotten our wheels underneath us and, we seem to be doing pretty well. The retail business has rebounded, particularly in our sector. Now the role of the CEO is to be out in front of the company, and try and figure out, what's next for our business. As merchants of shopping centers, and I call ourselves merchants because we really have to curate the mix in order to keep the property exciting. If we wait until we see what's cool and then put it in our center, by the time the store is open, it's not cool anymore. So we have to be out in front of what's cool. We need to be out in the world figuring out, hey, that would be real. That's an interesting thing. It's starting to percolate. Maybe we get there first. So we have to make some tricky decisions. We have to understand the marketplace, understand who our customer is, understand what they're looking for, and be willing to take a little bit of risk and be innovative and try and be the first one to do some interesting things in order to keep that customer flywheel coming back and continuing to shop with us and continue to be excited about that experience that they get when they're in one of our centers.
I think we are in a very challenging time, and on both sides of the aisle in politics, there's a lack of civil discourse. There's a paucity of real leadership. If you define leadership being something that is led with your heart and your mind is an inclusive and aware of all of us. I think this is a really unique time for a business leader to offer that within their own respective companies, to create a safe place where people can express their ideas, where diversity of interests and backgrounds are all embraced. And this is an extraordinary time in which you can do that in a world that is so lacking. And I have teenage children, and I watch what they're perceiving as versions of leadership on television, again, irrespective of political opinions. And it just seems like we're in a very difficult time. So I think a leader can truly lead by heart to evidence that kindness and civility is not a weakness, but instead an ace in your pocket.
That's great.
The rate of change, I think probably for the last 5 years, it's not just now, is just incrementally S-curves of everything. Yeah. Adoption is shorter and faster. So as I think through that, it's simply hire great people, but then let great people do great things. So at Link, and the way I think about it, it's empowered execution with accountability. Like really, when you hire someone, you give them freedom within boundaries to go and fail and push and drive. So many times leaders become leaders, and it's like, this is the way I did it, so we're going to control the widget. we've really tried to sort of, at Link and everywhere I've been, empower your people to go and take charge and deliver great outcomes.
Yeah.
That doesn't always work, but
Yeah.
invariably you get better outcomes long term.
Make the system and machine beyond just yourself as the leader.
I'm the weakest link in the Link
Link,
ecosystem,
right.
that is for sure.
Great. Well said.
Yeah,
Kathy?
I mean, for me, I've been in leadership roles for a very long time, and I think this is the most challenging time for a variety of reasons. The pace of change, the emotional boiling point in the country and in the world, the multi-generational workplace. I think there's a little bit more tension from that perspective in terms of different generations thinking differently, valuing different things. This notion of the pandemic and bringing people back to work. I mean, there are so many challenges. And I think ultimately what you have to do as a leader in this environment, particularly in an industry that, we're kind of wondering, are we in a recession? Real estate was in a recession, and we had a major repricing. We were not doing well. So you have the actual business metrics not great, and then the environment and the zeitgeist being, sort of very tense. And I think as a leader, you have to balance that. You have to give people confidence that the business is going to come back and that the business has everything that it needs to do well. And at the same time, you have to be very sensitive and aware and empathetic to how people are feeling. And I can tell you, when I first started in this business, nobody cared how I felt at all, especially as an analyst. But now, it's people have different expectations, and the workplace is, I think, a little bit more reflective of life in general than it used to be. And as a leader, you have to lean into that.
Thank you all for sharing that. Thank you all for a fantastic discussion. We covered a lot of ground. A few things that I'm taking away. We're hopefully crossing an inflection point in terms of where we are in terms of the real estate market. A reasonable amount of bullishness across panel. Things will get better hopefully next year. Next year will be the year that they get better. Leaning into performance is more important than ever before. Having control over your operations, getting insight from the ground, leveraging data and AI is more important than ever to be able to outperform. And this is not the time to sit back. This is the time to lean forward and really lead organizations through this change. Thank you all. It's been a great discussion. Hopefully you all enjoyed it.